It is that time of the month again in which we will have our strategy meeting. This is where we bring some of the traders from our desk to talk about some themes, maybe some trades, some ideas that they may be seeing or speculating about over the coming few weeks. And I'd like to welcome in Event Trader and Chart Trader, Scalp Trader, and Blue Chip Trader to our session today. Welcome, gentlemen.
What's up, everybody?
Howdy, Jim.
All right, so Brett, I'm going to lead off with you. Brett is Chart Trader, just for everyone out there. And the reason why is because you take a top-down approach. So I think that's a great place to start because you're involved in so many different markets. You're involved in gold. You took some profit in crude oil today. You're always active in the equity market. So what are the key themes that you're going to be focusing on over the next couple of weeks?
Okay, so I think right now this entire context is defined by a big question, which I'll get to in a second, and a big dilemma, which I'll start off with. So the big dilemma is the divergence that we're seeing between the United States and the rest of the world that just seems to be widening right now. So global trade contracted the most since 2009 in the 3 months ending at the end of February of this year. But the U.S. just did 3.2% GDP, basically across the same section, and you can see the impact of this. I mean, South Korea, for instance, had its biggest GDP correction or contraction in a decade, and at the same time, you've got Europe kind of sliding. Italy just adjusted down their GDP expectations, and the U.S. is doing well, and that's really showing up in a sort of big, gigantic breakout in the U.S. dollar index to really what amounts to a multi-year high over the last few days. And we see it in the euro, but it's not really just the euro. It's kind of across the board. And positioning in those markets is has been betting on this because it seems very foreseeable. It seems eerily foreseeable. And it's one of those interesting dynamics that you get in currency markets probably more than any other asset class where you have people who are in a consensus crowd in a herd, and they still end up being right. It seems to happen more, I think, in currencies probably than anything else because there's so many other inputs to the change in the value of a currency than just the traders. So either way, the dollar's breaking out, and that's this big divergence, and that has a lot of ramifications, and it could turn around and become a big risk for things because there's a ton of debt around the world that's denominated in dollars that is held by people who don't have the ability to print dollars. And that's where things really kind of get tricky. But that's hanging out there. That's a big dilemma. The United States really, to thrive, needs the rest of the world to be doing at least okay. And if you start to get sudden contractions, particularly when it comes down to trade, because that's really on the nose as far as the issue, then it can feed back into the United States and end up kind of circling back around and hurting us. And it also, to have a dollar that's strong, I mean, it also hurts supranational corporate earnings, hurts all sorts of things. Helps the small caps, but at the end of the day, you really don't want a big run higher in the dollar. There's more pain from that than there is joy across the market. So there's a dilemma, and it may be an accelerating dilemma. Positioning is a little bit of an inhibitor there, but again, it could really run. Now, to the big question, to me the big question is, so we've got this really weird situation that Gavin and I covered on Tuesday in our new Sentiments and Flow show, where you've got this strange kind of dichotomy between different versions of sentiment data. You've got some pieces of sentiment data that really look at market indications that show things like bond spreads and the TED spread and factors that have to do with how people are pricing different markets and that those can correlate to the idea that people are overly complacent. But at the same time, you have survey data, hedging data, and cash flow data that suggests that positioning in the equities market right now is still amazingly enough kind of timid. And so the big billion-dollar question, trillion-dollar question right now is, are we in a situation where all these guys who have been sitting out this rally can be forced in by continued improvement in data? Is there a threshold, or are they just going to sit it out no matter what happens, basically trying to lever up? And what I see right now is there's a lot of hedge fund leverage, and the hedge fund's leverage, I believe, is going into corporate debt, and they're trying to make corporate debt act like equity returns, basically by levering up 3 to 1, 4 to 1, 5 to 1, 6 to 1, 20 to 1, whatever you have to do to turn small moves in corporate debt instruments into a return that can keep you, catching up with your benchmark in an equity system, because they don't want to touch equities, and the correlation between the HFRX and the SPX is extremely low right now. So we can tell that the hedge funds have not really been participating. We're seeing institutional fund flows out of equities. We just saw another 4.4 billion flow out of equities over the last week on what included a breakout to the upside. So the huge question here is there a point where things seem to improve enough that all this money starts to pile into equities and you get this kind of melt-up scenario? Or are they going to abstain sort of no matter what? So there's one big kind of focal point, is trying to figure out the implications of that dilemma, and then figure out a hypothesis to that big question. So there's one part of what I'm looking at. Beyond that, I really like how gold is acting. You remember your Florida Gator line that you had on your gold chart?
I do.
It went right to it, right below it, flushed out underneath it, and now we're seeing just the sort of thing we want to see, which is it weathered that dollar breakout and didn't decline. It weathered this GDP number and rallied. All these are signs of money wants to be in gold. So I got a question from somebody earlier today. Am I going to increase the position size? I got in half size and use the ETF to avoid the contract rolls, because I think I'm going to be in this probably for a while. That's my guess. My response was basically, I think that I may increase it, but I think I probably want to treat this position as a core position and then use futures positioning to basically trade around that at key moments. And one of the big reasons is because I really I've been through enough situations where I'm excited about a position on a larger time frame. I increase my size too much, and then suddenly you get this, you're feeling the day-to-day movement a little bit too much, and it causes you to want to take profits on little pops and worry about little dips, and you end up really not being right on something where you don't make nearly as much as you should have. If you just stayed smaller, just stayed patient, didn't watch it as closely, and just let the whole flower bloom. And to me, the flower blooming on this gold pattern is really on a weekly chart, and it's really a breakout probably above 1400, maybe testing 1500 a year from now, and just kind of letting that process happen. It's a really large time frame, bullish ascending triangle, and I think it's a really good position the way that it's acting right now so far. So I like what I'm seeing there. I'm involved in that. And then, as you mentioned, we had the crude oil short over the last few days was really just basically a simple situation. One of my favorite types of setups is when you have an extended trend, you have a kind of marked threshold of either resistance or support, contrarian to whatever that trend is, and it's acting that way, and then you get a big headline that flushes it out further, kind of overextends the trend. Let's call it hyper extends the trend. And then you see that catalyst really could be reinterpreted over some kind of response. And that's a kind of interesting, simple setup, especially when you have positioning data that suggests some vulnerability. So in the crude oil market, we have commitment of traders data showing large speculator net interest at well over 500,000 at this point. That's in the zone of vulnerable. We got the White House announcement earlier this week to basically say, we're not going to renew the waivers for the Iran sanctions on May 2nd. So, we had a big breakout in crude oil when it was already kind of overextended and sitting at important resistance. So you've got all those factors together, and that's a catalyst that could easily be reinterpreted, and, that's the bet. So we short oil, and we wait for it to be reinterpreted. And it's been reinterpreted by both the White House coming out and saying they're going to make sure that OPEC steps up and fills the supply gap, and by the Iranian foreign minister basically saying China's already told us they're not going to play ball with what the U.S. wants to do. And the question really that arises there is the U.S. going to tank the U.S.-China trade deal on the basis of trying to enforce the Iran sanctions against one country? And the market is telling you probably not. So that kind of spilled oil today down as much as maybe 4.5%, got through our target. We covered on the news that Donald Trump apparently called 1-800-OPEC and said, keep oil lower. And, that was enough to kind of get me to say this is the opportunistic point to cover. So that's where I'm at right now.
Is there a spot that you would start to maybe favor a long trade? I'm looking at this daily chart and thinking $60 it would be a place where at least some people would think about reloading. Yeah, so 60 would be a place that you would start snuffing out another long.
Well, the first I was looking today, I would have done it at 61.70, and it didn't get there. It flushed down. When I saw it break 63, it started to pour out a little bit more, and I was really interested to see the extension went down through the trend line that defines the entire rally that we've seen off of the lows from December. So we broke the big trend line, and I really didn't think that it was going to get there. I thought it was just going to go into that shelf of support around 63, find support maybe 62.75. We've moved down through 62.50. We broke that trend line, and at that point, I'd like to see it go to the base of the prior short-term consolidation that we saw from, I think, April 2nd to maybe April 5th, which has a base around 61.50, 61.75, somewhere in there. Mm-hmm. So I would have liked to see, if it broke that trend line, to get to that next kind of little base level, and it didn't quite get there, and I would have probably been buying if it had kind of an emotional overextension, a sort of puke down to that level. I think that would have been an interesting spot, but it looks to me like we're starting to see some stabilization. Maybe not. If it breaks back down through 62.50, it could go again. If it goes again, then I'll probably be looking at 61.75 area.
All right, that looks good. And just before I jump away from you on this one, you had some interesting thoughts regarding the Fed funds futures yesterday, that it was up significantly from a week ago, and that has to do with what you were talking about with the dollar, right?
Yeah. I think it's interesting. Well, no, maybe that's causing it. So maybe that would be the inference. The weird thing is that Fed funds futures is showing. We're seeing clearly improving data. The durable goods orders, if you take out defense and air, you end up with, I think it was the best in something like, what was it, 7 years or something? As far as year-over-year change, it was or maybe it was 3 years. But either way, biggest jump we've seen in a while. And if you take a look at the period that we've seen, November, December, January, we saw sort of, let's say, a gully in the economy. And that number to me, because when you strip out defense, when you strip out air, you're taking out big ticket items that are not really spurred by sort of Joe everybody demand. And you end up with something that is really sort of, the Joe everybody. What are we seeing as far as real end demand underneath the surface for durable goods? It gives an indication. And for that to really pop up out of that gully in a significant way is another signal. And along with the 3.2% GDP, how do you have a situation where you get a number like that and then, well later that day, you see Fed funds futures are basically almost pricing a majority opinion cut in September. So I don't know whether that, it could be that the market is saying this dollar's too strong, there's going to be too much pressure from the White House. I don't know. To try and kind of bring things back in line. Or maybe it's about the divergence that we talked about at the beginning of this. Maybe it's about the fact that there is such a divergence that if you let the dollar just go on a breakneck pace in a runaway breakout, it's going to cause all sorts of problems, and maybe the Fed will just find some convenient excuse to say, you know what, we really need to overshoot inflation well above 2%, so we need to figure out a way to cut. This has nothing to do with Trump telling us to do this. We just know we need to do it because of our model or whatever. I don't know. Maybe the market's saying they'll find an excuse to do it, but it's interesting to see the data markedly improving, and at the same time, the odds of a cut and the time frame of a cut getting nearer, both kind of, increasing. So I just thought it was peculiar.
And I find it peculiar as well, because if we keep having good data sets, then logic would tell you there wouldn't be necessarily a reason to cut, right?
Well, I would think, I know people don't normally take earnings as an economic indication, but, it really is. If you see strong, I would say this earnings season, from what I've discussed with my colleagues, this is an earnings season that's not just been better than feared. It's been, surprisingly good. And I would say the
It,
GDP
it
number this
was
morning was
surprisingly good up until the last couple of sessions, I would say.
yeah, right. Yeah, so some semiconductor issues and 3M, and I guess you'll probably talk much more knowledgeably about that. But I would say that's still an indication when you look at the contrast between how things are going in Europe and how things are going in the United States, and you look at the sort of earnings reports we're seeing, it just doesn't fit with the model of cycle end or an accelerating deterioration. And that would be what you'd expect to see the first cut of a cycle, is an accelerating deterioration, and everybody aware of that, rather than this, what appears to me to be a strategic or hyper proactive kind of model, because the market is saying something, I think, other than, normally the first cut comes when you see kind of unequivocal signs that you're seeing a breakdown in the cycle on lots of different levels. Because usually there's a kind of inflationary pressure overhang, and this would seem extremely proactive, and the market is pricing it, or just about for September, just a couple months away. So that's, I don't know whether that's I don't know what that is. I just wanted to point it out.
All right, so that's a great place to bring in Gavin, because you really do focus a lot on earnings. Everyone hears about it when we talk first thing in the morning, and if this was a boxing match in terms of scorecard here, I'd say it's 3 rounds to 1. We've probably gone about 4 rounds in a 10-round fight, and it's been pretty good so far, other than maybe the last day or two.
Yeah, well, as Brett was saying, we were off to a pretty good start. Now, financials, better than feared. They weren't fantastic by any stretch. Loan growth was certainly down a little bit, but everybody had been expecting that, and again, those results were coming in a little bit better than the expectations, so that got us off on the right foot. And then we started to get a string of pretty nice reports coming in, and that over the last couple of sessions has seen a little bit of a trip up, particularly in the semiconductor space. Now, here's the thing, everybody knew that Q1 was going to be weak for semiconductors. We've seen it played out. Certainly the Q1 GDP number from South Korea highlights it as well as anything. But I think what was getting people was everyone was like, okay, so Q1's going to be bad, Q2 is going to be the bottoming, and then the second half we're going to see the recovery in the chip space. However, then we got Texas Instruments a couple of days ago that they wouldn't come out and say that they're seeing a bottom, and in fact, they remained pretty cautious. And then we saw Intel highlighting how much of a slowdown that they're seeing in China and seeing that it's getting worse. Now, the question is this company specific, or is China behaving worse than some people believe it is? We've been seeing a little bit of signs of a bounce back in Chinese economic data. And now all of a sudden some of the commentary that we've gotten from 3M, from Intel, Texas Instruments, and the like are really bringing that into question. There's already been enough concerns about Chinese government economic data in the past as it is, so when you start seeing some of these U.S. corporations highlighting the slowdown in China, it raises a red flag. And then there's the question of, well, what's behind it? Is this a trade-related issue, or is China just continuing to drag? And I think that's really raising some serious questions here. And of course, NASDAQ has really been leading this rally higher in tech in general. So, I just look at a market that's looking for leadership, and you just look around at some of the sectors with semis that have been so strong and a part of that bounce over the last couple of months, going back to December 24 lows. Now all of a sudden they're rolling over a little bit on concerns around that bounce back and whether or not the second half of 2019 is going to be in play. And you're looking for other leaders. Rail's been extremely strong, but they've come out with decent earnings reports, but nothing too great, and we're not really seeing them press higher above. Then you see aerospace and defense, and they're all coming out with great results, and you're seeing those shares get reversed. So I just feel like we're in a place where earnings is coming in. We still have another 5-6 rounds to go, as you were saying. Certainly some big names next week. We got Google. I don't think Apple's next week. I got to double check that. But AMD, Cigna, Square, Qualcomm, still a ton of big names to come out, but we're starting to see a little bit of a falter on those news. So I think we're just in a market that is looking for leadership, is waiting for a little bit more signs from some of these earnings to come in, and then is dealing with a macro backdrop that appears to show, as Brett was saying, a divergence with the U.S. just really outpacing some of the peers. I mean, the weakness in Europe is very well documented, and that drag on the euro against the dollar, which makes up 56% of that Dixie, plays a large role into where the dollar goes. So you got all these factors coming in that just really, to me, points to a little bit of sideways action until we get a little bit more clarity, because until we can find some good leaders coming in and we get a little bit of a settling on the macro front, it's tough to see people getting overly aggressive. And I think we've seen that a lot as, Brett and I have been talking with Brett, what was it, the most recent outflow of equities? Another $5 billion?
4.4.
4.4. So, I mean, people still aren't buying equities. Like Brett was talking about, corporate debt is getting a little bit overdone here at the moment. I would say that a lot of these companies have been improving their balance sheets with the earnings returns that they get from the tax windfall. So that's positive. But you can see these names that have high corporate debt like AT&T or Verizon really getting hammered a little bit and pulling back in. So again, that brings it, just building off of that brings in a question just to kind of show the top down where people are concerned about corporate debt. AT&T's getting hit. Verizon's getting hit. One of the big stories, one of the big performers over the last couple of quarters has certainly been telecom providers as they ramp up for the 5G. What happens if we start seeing this dollar running away, corporate debt getting in under a little bit more pressure with interest rates, and instead of spending the money on the 5G rollout, they have to use more of that money in order to pay down some of the debt. And these are all issues that are really weighing in on the market concern that is leading to the idea that we can't really find leaders right now, because the ones that have run, the telcos, the tech spaces, the rails, they're just at such a rich valuation, people aren't wanting to chase. And then when you look at some of the bottom feeders that have been getting hit, like a health insurance or something, people are still concerned to get in there. So we're not really seeing a rotation. We're seeing plenty of concern around the macro. Strong enough data and earnings to keep people from selling, but again, just kind of leading us into a sideways direction that it's tough to see where we're going to break out at the moment.
So let me ask you this, since I have you both on right now, Gavin and Brett. We've seen some outperformance today in the IWM, so the small caps, and this has been lagging the broader market. We've talked about this at length, and small caps do better when we have a stronger dollar. So therefore, do you think there might be a rotation coming in small caps that could shift away from, say, the S&P and NASDAQ, maybe some of the higher valuation names, into some of the small caps now, really banking on that dollar strength that we're seeing?
I think it's a great idea.
Yeah. I like it based on the dollar strength. And it just as a reminder for people, we do have a Fed meeting next week. There's not going to be any updates to the projections, but obviously Jerome Powell will be speaking, holding his press conference. And then notably the day after, or the Friday after, there's 7 Fed speakers. So you can kind of tell that they want to get this message across. And not get anybody concerned, because with the idea that they're going to have this and then everybody following up to make sure that that message gets properly across.
Just technically, I think there's no question that we'll not see 160 on IWM, and the question is, do we reject that breakout? That's a range. Obviously, if there is this persistent feeling that the cycle is somehow going to stunt itself, the small caps will get hurt, but given the context you just described, given the context Gavin just described, given the context I just described, the idea that you have people who are lagging in performance relative to benchmarks, paired up with the idea that the United States seems to be a unique incubator for growth, paired up with the fact that a lot of these small companies are purchasing their inputs in dollars and then selling it to people with dollars. allows them to take advantage of the currency appreciation, just like Gavin described. So all those factors would seem to suggest that unless there's an imminent issue with the cycle, you should start to see that kind of catch up.
Do you ever trade the Russell futures, Brett?
You know, it's interesting. I really don't, and I can't account for why. It's just
Because it's on the wrong exchange.
Yeah, it's on the wrong exchange, and I just, it's like I've traded for so many years at this point, and I have the instruments that are on my home field, and I watch it and I think about it, but for some reason, it tends to not be where I go to when I understand what's going to happen.
All right, so Blue Chip, this is a great place to bring you in because you are no stranger to trading small caps. You highlight the IWMs every day, as I do, and so I'm wondering if you might agree with that sentiment, or maybe you disagree.
The one that the U.S. dollar's strong and is going to
Well,
lift
yeah,
small
I mean, are
caps?
you going to be maybe looking at more small cap names as opposed to the larger names, or does that not make any one bit of difference to you?
No, it definitely does. I mean, everything is always bigger picture for me, so it's always a piece of the puzzle. Obviously, the relative laggardness in small caps performance over the last 2 months, the IWM has not been able to successfully accelerate over the 200-day moving average, get over the March highs or the February highs. That's somewhat of a yellow red flag of caution to me as larger cap peers trend higher here going into March and April. But at the same time, earnings season is usually flooded with the larger cap bigger names early on, and then as Gavin calls them, the ham and eggers usually come out mid to later on in the earnings season, and that's when you typically are going to see more of the IWM become a little bit more responsive to earnings season. So it's right there, and it's not, like I said, it's not particularly bearish. It's not like showing any sort of negative divergence where that's something we saw back in September and October, where we clearly saw the IWMs undercutting support levels, undercutting their 50-day moving averages well ahead of their larger cap peers. That was definitely a tip-off to the aggressive Q4 correction that we saw. Now that's not really the case. It seems to be just more of a consolidation phase, non-interest type of place where money's flowing at the most part. So, but yeah, the U.S. dollar, I am actually a dollar bull. The chart of the UUP, that's the ETF proxy for the US dollar on a monthly time frame, I view as extremely bullish. It had a stellar performance in 2018. It basically pulled back for about 2 months late in the year and then started off real strong here the last 3 months or so, trading back up at fresh 52-week highs. So the trend is your friend when it comes to the US dollar, and I think right now it's just, on pace to continue to go higher. So I think that it definitely could have a positive influence on some of these small caps as their earnings reports come out.
All right. Any particular names that you're focusing on, or you just wait and see, go through the charts?
Yeah, you know me. I'm very heavily on a sector rotation swing trader. And I'm always looking for some sort of leadership qualities, leadership names that are stemming from strong sectors. And usually my best go-to names are going to be from the GrowX focus list that we have that's published once a week, the emerging growth focus list, because those are your strong fundamental and relative strength leaders in the market. And those would be, the more liquid ones would be more my go-to names, and the ones that I see some other traders on the site that I listen to, that the ones that they tell us they've done a little bit more legwork on the research and the companies and whatnot. And then I'll start looking at the charts, trying to find opportunities there. So that'll probably be more my area of focus and interest going into May.
Hey Scott, is it as simple as you're just still seeing cloud software as the leader at the present time?
Yeah, there's no denying that. Yeah. I mean, take a look at the IGV, and yeah, I know Microsoft is a heavyweight in there, but you also have all your Salesforces. The Salesforce looks great here. I mean, it's been consolidating for 2-3 months, and now it's banging up back up against fresh April highs, looking like it wants to move higher for another leg up. Adobe continues to shine, new highs. Autodesk, another one. Microsoft had a fantastic earnings report, gapped up again. Didn't see any sort of aggressive profit taking, just consolidating those gains. The list goes on and on and on. Zscaler, we just mentioned that one, looks great. Okta trading up to new highs. VEEV. Now I'm getting into a little bit more of the mid to smaller cap range. So these are all on the list there. ServiceNow, NOW, fantastic response to earnings. Workday, WDAY, another name that's just breaking out above 2-month consolidation ranges there. Sectors are so strong here. I'm just not seeing any sort of aggressive distribution activity. And even when those one or 2 days come by where it seems like everyone starts to turn extremely negative on these software names, that basically fades within 24 to 48 hours, and then they're bought up and snatched up and taken right back up to the highs. So,
what do you think of the Proofpoint move today?
PFPT. This is a name that I don't particularly watch, just because the volume trades under 1 million shares and sometimes even 500,000. So it's not one of the more liquid names that I tend to track. But you know my theory on earnings, so I'm always looking for something disruptive to happen and to give me a signal. And Proofpoint has had a really great performance and great constructive activity over the course of the last 3 months since that last earnings report where it gapped higher, and it's just been steadily just moving above the rising 50-day moving average. So you have a response today that basically the stock looks like it only opened down maybe 2%. That's not anything disruptive by any means to have the, to shake the tree of longs that have been in this name for the last couple of weeks, or any sort of fund money that has been in the stock for a couple months. And staying back above the 50-day moving average is also just a basic, simple textbook technical analysis tool to keep you on the right side of a trade. So it looks like it maybe got ahead of itself prior to their earnings report. So you saw some more aggressive traders taking advantage of trapped longs from recent days, but overall there was nothing disruptive here on the chart. Technically, it's still in context of a really strong multi-week, multi-month uptrend above the 50-day moving average, and I like how it responded right off of it at that 120 area. So I would say it's still pretty strong, and that's me looking at nothing about the fundamentals. I didn't see anything if it beat or it missed or got it above or below. So I think it still looks pretty strong because of that sector. The sector is so powerful right now.
All right, next up is scalp trader. Damon, I want to ask you, I'm curious, have you ever dabbled in any of that corporate debt securities or anything?
Yeah, I mean, I've traded corporate debt for a few years, and under some of the changes, like the government regulation that required basically the big banks to back away from some of the corporate debt markets, the liquidity really dried up. And so, look at corporate debt this way: unless you plan on holding it until maturity, be careful, because the liquidity is really poor. When you want to buy something, you have to chase it. And when you want to sell it, there might not be a trade for sometimes weeks. I mean, I remember the last trade I made in a distressed oil name probably 3 or 4 years ago in the corporate debt market. I bought it at, I think about 40 cents or 50 cents on the dollar, maybe around 45 cents on the dollar. It ran up to about 75 cents on the dollar. I was looking to get rid of it, because I just thought that we're going to have another pullback in oil prices, another leg lower in that whole complex. And I was trying to sell it for 2 weeks straight, and I eventually ended up selling it at 28 cents on the dollar. So you can have some, it's definitely trade by appointment there. So I really haven't done a whole lot. I prefer the preferred market. So I kind of use that instead of corporate debt. Typically you have higher yields. They trade just like individual stocks, and so you can get in and out pretty easily. And as you know, I have a whole yield portfolio full of preferreds, and I think it's one of those markets that's really underappreciated, especially for people who are looking for income as part of their kind of portfolio structure. And you can also do pretty well on the capital appreciation side of it as well.
Yeah, and the reason why I asked you about the corporate debt is because if Brett's theory might have been true, that maybe there'll be some performance chasing through the corporate debt market, I was wondering if there might have been a way to take advantage of that, just kind of ride that wave. And if anyone would know, I thought maybe you would. So, but buyer beware, because things can get pretty illiquid.
Yeah, I think there are ETFs for it. Yeah.
Okay, yeah, so maybe through ETFs that might be a good way to take a look at that, and I'm sure we'll dive into that a little more as the weeks unfold. So, what are you seeing as big themes, Damon?
That it's really, really quiet. I consider myself a speculator, and one of the important things is just to recognize when opportunity isn't there. And in terms of what I do, I don't really see a whole lot of compelling opportunity right now. Swing positions are generally doing well just because the market's in an uptrend. In terms of short-term trading, I'm sitting there and usually finding 1 or 2 trades per day, and trying to get in at the open and try to be done by 10:30, 11. Well, that's Central, so 11:30, 12:30 Eastern, because things will dry up in the afternoon. Just not a whole lot going on. Kind of going back to preferreds. I think that if the preferred portfolio was not doing so well right now, I'd kind of be sitting here just trying to figure out, what am I doing with my life? The fact that there are very few trades out there on a daily basis right now. But, again, when I talk about the ability to pick up very compelling yield plus capital appreciation potential, let money come in while you're sitting there waiting for more compelling opportunity. I always kind of emphasize that, because it really can be a really important part of your portfolio structure and your overall returns.
All right, so feel free for anyone to interject on this one. I think we are all mostly in a consensus that we expect the market to make a test of the all-time highs in the S&P very soon. Now, if there was some type of risk event that would catch everyone off guard, because, let's face it, black swan events, no one sees them coming, what might be a couple of big risks in the market that might prevent us from testing those all-time highs?
Trade talks falling apart.
Okay.
That would certainly be one. Any escalation in Europe around Italy's budget or anything along those lines? We've got Spanish elections this weekend. Any acceleration in a hard Brexit would certainly be an issue. More on the sensationalized piece, but not completely out of the question, is if Iran did something in the Strait of Hormuz that could flood oil. So there's definitely black swan events that are out there. And then, some of the more regular ones. I still think the biggest question is whether or not we see that second half recovery in the chip space, and the fact that that still lies out there is a pretty big overhang. But there would be a few things that I would have on the radar for potential black swan events.
I would add, so I would say everything that Gavin just said, I would wait till the downside momentum peters out and buy it. And the thing that I would say you don't do that with is if you see a serious and marked strong deterioration, consensus deterioration in economic data. I mean, that is the one that could happen given what we're seeing in the ROW, the rest of world, and given what we saw in the updated trade data. If that starts to happen, that definitely, importantly changes the real underlying picture.
And I think one of the things that would do, Brett, too, is drive potentially a runaway buy in the dollar, which would pull into your corp. Yeah, at first.
Until that, then yeah, right. I mean,
then everybody's going into gold and Bitcoin.
We don't live in we don't live in a vacuum. So. Right. Initially, that's what happens, and then that falls apart too.
But that initially would also cascade into, as you were saying, into a lot of those debt markets that on the side.
And it all ends up where? It all ends up, to me, it all ends up to gold, and that's why I'm in that trade.
And Bitcoin.
And possibly Bitcoin.
for the millennials.
You're in GBTC still, right?
I am.
Yeah, that's a nice trade.
All right, gentlemen. I think that pretty much sums up most of the themes that we're seeing, and we have you guys on pretty regularly. So if we have any updates, we'll sure to get you guys on. If you're seeing anything, we'll try to get that out in front of everybody. Maybe one more thing, Brett. I was talking about the euro, and because we laid out a scenario not too long ago, because I put Florida Gator colors on there for that line. So we got through that area, okay? So that 112.50 area, right?
Yep.
And you were looking for a potential breakdown through that, and maybe now a reversal. We got an outside day brewing, and that doesn't mean a whole lot just yet. But are you at least thinking about seeing what's going on in the euro, or does this dollar strength just make you just pass?
Well, I mean, it's the big dilemma we talked about, and the positioning is so important here. Everybody knows Europe is massively weaker than the United States. Ask anybody who's involved in markets in any way. It's the main thing they know right now. The main thing across everything. The average number one fact probably on Wall Street is that Europe sucks and the United States is great. And that is probably the main thing that everyone knows. So you see this huge short position in the euro. If there's any process, even around the corner, because around the corner is always the interesting thing to look at, if there's any process of convergence that could happen here around the next corner, there's a heck of a squeeze there. And it's already hugely short. But again, that's a dangerous thought with currency markets, because there's so many forces that determine the price of the euro that have nothing to do with financial market traders. So there's every transaction that happens with euros and dollars, every movement of money is part of that market. So it's a huge market. It's the biggest market, and not that much of it is traders. But the bet and the positioning is already consensus downside in the euro. So the question is, how much can this really extend? And are we going to see this continue, this wave? And Scott was noting his bullishness on the dollar as it broke out, and technically it certainly looks, pretty spectacular. So I have a tough time chasing because of the positioning, but it's a currency market. It could keep happening. It's just if we do see convergence around the next corner, then it's a wicked squeeze.
Is the positioning data from the CFTC, is that a good proxy to look at, considering? Well, just because it's looking at the futures market, and the futures market is so. Yeah, and I'm just painting the picture for the listeners.
I got an answer for you.
Okay.
I got an answer for you. Okay, the answer is political polling. Okay. Right? So how do they know a candidate is, like, let's say on election night, we start to get some early exit polls, and one candidate, even in a race that's like, let's say, a statewide race or something, a governor race, and you see just a couple 100,000 votes, but they're from all different areas, and one candidate's getting twice as many votes. You know who's going to win. It's already, political scientists know this. When you see that, it's over. It's already over because there's a sampling pattern. When you start to get enough different and diverse points of view, and they're all kind of agreeing in this. So I think the futures positioning is kind of like a political poll. And I think that it doesn't cover that much of the market, but I think it does cover traders sufficiently, statistically, significantly. There's a lot of adverbs together, but I think that is effective that way. Now the question is real money flows between countries, because again, there's very little of the price of a currency that is determined by traders trading financial positions. So that's the big factor. But I think that traders unquestionably are positioned for a move lower in the euro right now across everything. And I think the futures data is, to me, my opinion, futures data, I believe, is a statistically significant measure, like a poll, of what traders feel about that market.
All right. Well, hey, that answer is good enough for me. I just wanted to get your take, just because the Forex market's so big and futures, let's face it, the volume in the EuroFX is minuscule compared to the amount of money that's moved in the Forex markets. But hey, that answer makes sense. All right, fellas, unless you have any parting shots that you want to get out here, we'll wrap this one up. Anything from you, Gavin, maybe?
Oh, sorry, it's just on mute. No, I think pretty much summed up where we're standing. I know we would love to have something a little bit more definitive in terms of exactly where we're buying, but we're just kind of at that place in the market right now where we're trying to work through a few things. We're positioning for stuff, Brett, obviously in that gold trade, and keeping an eye out for intraday trades and watching those sectors closely post earnings. Next week's a real busy week for earnings. We also have the Fed. We got EU elections toward the end of the month. We got those China trade talks over the next 2 weeks. So hopefully we get a little bit of solving going on before we go into that old sell in May and go away type pattern. But the next couple of weeks are definitely lining up to be potentially exciting for the markets. So just continuing to watch that action.
Yeah, and a reminder, next week, big week, not only the Fed, but we have the non-farm payrolls on Friday as well. So Yeah,
exactly. Huge data. We got all the PMI numbers coming out. We got personal income and spending. Europe's also closed on Wednesday, just as a reminder.
Gavin, you just posted something yesterday. What was it? You said April 30th. There was a lot of political stuff.
We've got, there's a hearing on Medicare for All, which obviously, healthcare has been a major drag on the markets. It shouldn't be that impactful, but something that we do want to take note of. And then also Mnuchin and Lighthizer are expected to go to China to meet with Liu He, their Chinese counterpart. So hopefully a little bit more clarity on that. I would note that the One Belt, One Road speech overnight from President Xi Jinping suggested that they continue to go down the road on this trade deal, and we're getting closer to it.
He said Trump and Pelosi meeting on infrastructure.
Oh, and Trump and Pelosi meeting on infrastructure and drug prices as well.
That's all April 30th.
It's all April 30th. So yeah, April 30th stands as a pretty busy day, and that's the day before the Fed, of course. That'll be right before we get a number of PMI data and stuff like that out. As a reminder, most of Europe's closed on Wednesday, which would be the day after. So should be an interesting week next week.
Yeah, to say the least. We do have a lot of data points that we're going to have to look at. So the safest thing that we can say is stay tuned over the next couple of weeks, because with earnings and the Fed and non-farm payroll, all the PMIs, all those things that Gavin just highlighted, things should be interesting, and there should set up a lot of opportunity. So as always, gentlemen, thank you so much for joining us, and we'll do it again next month.
All right, talk to you guys soon.